Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. I hope that everyone had a good weekend. Certainly glad that everyone could join. As we navigate here the second week of June, what we saw last week was sort of an interesting pullback, or I guess a bounce, and then a pullback near the end of the week in the market. But more specifically, a lot of the areas that have been outperforming over call it the last 3 to 4 months, you saw those areas be the recipient of some profit taking. Meanwhile, you actually had some of the areas within technology, those more growth oriented areas, those things starting to bounce back. And, for us, one of the reasons I think that we've been able to outpace the market in our growth sleeves this year is that we're staying focused. We're not trying to chase the market every time the market goes up or down. What we're specifically trying to do is look at mean reversion, saying, what are those areas of the market that are drastically undervalued relative to their growth profiles? What are those areas that are underrepresented by investor dollars? And then lastly, what are those areas that have specific catalysts in the next 3 to 6 months that can unlock some of that deep value that we've identified here at LifePro? So we'll go through all of that this week. The title of this week's presentation is Finding the Next Nvidia. And, we get a lot of questions of why don't we own Nvidia, right? And the truth is, we missed the Nvidia trade. And, when you miss a trade, it doesn't matter if it's Nvidia or if it's Tesla or if it's Apple back in the day or Cisco in the 90s. I think the worst thing you can do is say that a lot of people own it and you don't know what their cost basis is and you chase it. The worst thing you can do is chase a stock. And, there's a phrase that my first boss once told me, and that was that, at the end of the day, there's always going to be another stock to buy. Now, he may have used it and colored that phrase in a different way using different words, which I won't share. But the message there was that there's always going to be another story to invest in. There's always going to be another stock that is in the first inning versus the eighth or ninth inning. And the worst thing that we could do is say, hey, you know what? We missed this stock, so let's chase it now. And so that we can put it in the portfolio and people get excited about owning it. Because at the end of the day, the only thing that people get excited about is making money. And that's what we got to really stay focused on this year is what are those areas that we can buy into that we think are in the first or second innings that we can help clients make money in. And so far this year, you've seen those growth sleeves up double digits. We want to keep focused on those areas where we think there is significant potential for returns, both over the short and medium to long term. So three big things this week is, small caps versus large caps. Are we starting to see a turn there? We're going to address that. Number two, emerging markets versus developed markets. Are we finding a bottom? And how should we play that? And then lastly, are global and U.S. rates peaking? And that's a big one, right? Because we obviously saw a strong labor market report here in the U.S. last Friday. But when we look overseas, the trend is down for interest rates. And we do believe in the concept of gravity. So we'll go through that concept of gravity and how it impacts the bond market and how that ultimately impacts asset allocation. So in terms of a quick market overview here, the economic data continues to soften, but labor does remain robust. We saw that on Friday, right? We look at the non-farm payrolls, very robust, close to 250,000 jobs were created. I think it was about 240,000 or so above estimates. Again, that's a big number, but it's a comfortable number. And the reason why it's a comfortable number is it sort of takes that recession concern off the table. But underneath that labor number, we are seeing manufacturing activity slow down. We're seeing consumer spending slow down, which is what you want to see if we're getting into that disinflationary cycle. And that's what we need if the market wants lower rates. The inflation PEC report, that was about a week ago. Not this past Friday, but the Friday before. That came in lighter than expected. Again, another good check mark there. Central banks outside the US are cutting rates. So we've now seen 3 central banks, Canada, the UK, and of course the ECB, all have stepped up to cut rates. at some point, gravity takes over, and we do think at some point this year, the US will follow suit. What's interesting is that at the beginning of the year, everyone thought the US was going to be on a rate cutting storm. Now everyone's on the other side of the boat of no rates. We actually think those rate cut probabilities are starting to increase, which is part of the reason why we've increased that emerging market exposure. We've increased that technology exposure in select areas, both in the US and overseas, but more specifically overseas. Minor breadth contraction. So if we look at the chart here in the top left, you can see here the percentage stocks above the 200-day moving average stalled out a little bit. Again, this is a healthy level. It's nothing to panic about. Just some profit taking. When we look at the percentage of stocks hitting 20-day highs, that's definitely leveled out as well. And that is in conjunction with the market pulling back a little bit here. Again, markets and stocks are allowed to take a rest. When we look specifically at Chinese stocks or we look at emerging market stocks, nice pullback that we've seen over the last 2 weeks. That's okay. We saw that type of negative volatility 2 or 3 weeks off of bottom post-COVID. Same thing post-global financial crisis. That happens. Stocks go up a couple steps, go back one, go up again, come back. And so you want that 2 steps forward, 1 step back approach. And we've continued to see that pattern. So we like that. Tech and growth, as we said before, have bounced. Value in international stocks correcting. That's okay. We want to use that to our advantage. So what are our action items knowing this? First, we don't want to chase the bounce in some of these high price growth stocks. Again, miss the Nvidias of the world, not going to chase it here, right? For every Nvidia, we're seeing 5 or 6 of those cloud software stocks blow up to the downside. So we want to be very, very careful. You just have to look at the chart of something like a Cisco or an Adobe or Workday. You can go across the list on these cloud software stocks blowing up across the board to the downside. So we want to be careful, right? Again, so you have that leader that's been literally on fire to the upside, but the vast majority of the stocks underneath the hood have been breaking down. So please exercise caution there. Second item here, we want to use the pullback in emerging markets, value stocks, international stocks, MSCI EAFE to add a little bit more exposure, right? And we've been doing that. On the fixed income side, extending out duration across the bond market. And what that really means is, again, if you have a portfolio of 2-year bonds, considering some 4-year bonds, some 7-year bonds, some 10-year bonds, some 15-year bonds, right? Well, why? Well, because we want to lock in these attractive rates. And if you buy a 2-year bond, you're only locking in those rates for 2 years. You buy a 10-year bond, you're locking in those rates for 10 years. So we like the way the bond market is set up here right now. When we look at within the emerging markets, India and China are the 2 big components of the MSCI Emerging Markets Index. Everyone's sort of been, when I say everyone's a figure of speech, but sort of the vast majority of investors have been piling into India. We actually think India is somewhat overvalued. It's one of the reasons we've avoided that market this year. And good thing we have. Obviously the election did not go Modi's way last week. And you've seen a big pullback in the Indian stock market, then a bounce back. But again, where we think the bigger upside is where everyone's trying to avoid, which is China, where you're seeing their version of Facebook, their version of Amazon, their version of Tesla. All of those are trading at dirt cheap valuations, and there's really good growth associated with these stocks. And they have very clean balance sheets, political feelings aside between China and the US. And so what we can see here is, unlike India, which is showing a significant topping pattern with the percentage of stocks above the 200-day moving average continue to fade, and then, of course, a big negative vol day today or this past week on the Indian exchange. The Hang Seng Index, based out of Hong Kong, very representative of Chinese stocks, is doing the exact opposite, starting to bottom. Percentage of stocks at 3-month lows, very low despite that pullback, right? So again, showing some very healthy symptoms across the Chinese and emerging market index, ex India, right? So we're taking the contrarian position there, going cheap, going into China, staying away from India and some of those more expensive pockets within the emerging markets. Again, when we talk about that mean reversion trade, we really do think that international and emerging market stocks relative to the US has started to bottom. We think there is significant opportunity and potential with this trade. We look at November 2007 to May 2024. The MSCI EFI and MSCI emerging market price indexes are down on a notional basis, while the S&P 500 is up 247%. We think there's some mean reversion that will take place here. Why? Somewhat weaker dollar. That is very good for emerging market funding and their bond markets. We also think that growth rates are starting to pick up as China introduces stimulus into their own economy. And lastly, valuations. Valuations are just so cheap across the emerging markets right now. And I wanted to show that S&P 500 versus MSCI emerging market chart in one picture here. So the orange line here is the S&P 500 going back to late 2007, and then the white line is the emerging markets. Literally, had you invested that money in the emerging markets way back in 2007, you're actually down slightly versus the S&P 500, which of course you're just up significantly over the last 15 to 17 years. So we think this gap here between this white line and this orange line is profit potential, or what we call alpha or outperformance potential for our investors. Sometimes when you get early on in a trade, it can feel really lonely and dumb. But so far, we think those returns have started to pan out. And we think that this is where there is certainly significant opportunity ahead. Another area of mean reversion that we're really keeping our eye on is the Russell 2000, which are small cap stocks relative to large cap stocks in the S&P 500. So this chart here shows small caps performance relative to large cap performance. Right now, we are at levels not seen since the mid to late 90s. And we think that is significant. And at some point, this reverts. And we think we're close to that mean reversion point. Now, over on the bond side, we had a strong labor market report. We saw yields pop on Friday. We're not that concerned about that because that is one data point. Non-farm payrolls were strong. Meanwhile, the vast majority of economic data in the US has been softening. And we think that's a reflection of a healthy economic slowdown, not a recessionary slowdown, but a growth slowdown. So instead of growing 3 or 4%, growing 1 to 2%. And that should help bring those inflation rates back down, right? So you're winding down for the evening, right? So that's what the economy is doing. We're not jumping off a cliff. We're just merely winding down for eating, have a glass of wine. That's really what the economy is trying to do here. And that's going to help bring yields down, in our opinion. So what we've seen here, again, we talked about this at the beginning of the presentation, European Central Bank, Bank of Canada, the UK, cutting those interest rates. And then meanwhile, the US is starting to show that technical exhaustion on those 2 and 10-year rates. What do we mean by that? Lower highs, starting to break support to the downside despite the move up on Friday. And we think at some point, if the rest of the world is cutting rates, that acts as gravity for the US. Why? Because if let's make it extreme. If everyone's at 1 and the US is at 5, guess what? Everyone's buying US bonds and driving those yields down because there's that yield differential, right? So why own a Japanese bond at 1% if I can buy a US at 5? Guess what happens? If I sell a Japanese bond, I'm pushing the price down and the yield up. And if I'm buying a US bond because they offer much more attractive interest rates, well, guess what? There's more demand for US government debt, and the US government realizes this, and they don't have to offer as high interest rates, right? So those yields come down and the prices of those bonds go up. So we think over time, those yields come down, those prices go up for US government bonds, and we think that people will sell those overseas bonds in preference for the higher yields in the US, therefore bringing yields down stateside. So gravity is that powerful force that we want to take advantage of. And that really is great for emerging market stocks and those private companies that want access to US dollar funding, assuming that those US dollar comes down along with US rates. And again, we look at the chart here on the 10-year, those rates really do look attractive going all the way back to 2010. And even before that, you can take this thing all the way back to 2000. Very, very attractive rates. So what we're really, when we sit down with clients and advisors, what we're saying is, hey, listen, right now you can build a fairly low risk portfolio and get 7%, right? Are you happy with 7%? And a lot of clients are. Well, who cares if rates may go higher, right? That opportunity cost, maybe it's 1 or 2% to the upside. But if we're right and rates do come down, you may be losing out on a generational opportunity to lock in really attractive rates and build a portfolio that can generate 7%, 8% and have a relatively low risk footprint. So we think that's the real call to action right now. If you're looking to de-risk a portfolio, generate more income, and do it in a way that maintains liquidity, the bond market's offering a lot of solutions right now. Now, if rates back up and start to head lower, that window starts to close. And so definitely, I think it's something to pay attention to as you approach retirement, or if you're in retirement right now and are a little uncomfortable with the market ahead of the election, definitely look at some bond market solutions. In terms of credit markets, I didn't even have to change or update the slide this week. Nothing happened. The credit markets remain so sound, so robust. And again, we think if there was some form of some cancer in the system, some virus in the system, you would see it pop up in the credit markets. And we're just not seeing that. So we're being really patient with our risk portfolios, despite the pullback we saw in the past week, because again, there's just nothing out there that really sort of screams red alert. And so right now, just maintaining our focus on where we see mean reversion opportunity and taking advantage of that. So in summary, we think labor market reports a little bit of a head fake. Got one good report. You got many softer reports last week. Minor breadth contraction on the S&P 500, but trends remain strong. Nothing, I would say, really nothing to lose any sleep over. EM stocks are correcting. After a very strong run. If you've been in our portfolios, you saw that big strong run in March, April, and the first half of May. We're now correcting, taking some steam off, and then we think that move resumes to the upside. And then lastly, global yields are breaking down. At some point, we think that represents a gravitational force that brings U.S. yields down with it. So that's what we got for you this week. We think there's a very attractive long-term picture for emerging markets and international stocks versus the US. We definitely encourage clients to kick the tires for those parts of the portfolio that can absorb more risk, more volatility, because we think it's something like this doesn't come around very often, but we're super excited about that part of the market right now. So this is what we got for you this week, 888-543-3776. Please feel free to reach out to your advisor. And as usual, have a fantastic, safe, and fun week. Talk to you soon. Bye.